Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending January 31st, 2020. Let's get right to it. We've got a little bit of a black swan event developing. Remember the skew index in December, the black swan index going nuts? Well, perhaps this is what it was about, this Wuhan virus out of China. So this is a daily chart of the S&P 500. You might remember last week things started to get ugly with this bearish engulfing candle here. Closed off the lows, and this is this week. So the S&P lost about 2.1%, and keeping this in perspective, that's really not a lot, especially if you compare it to what the bond market, what the commodity market, and even the currency market have been doing the last 2 or 3 weeks, more broadly the last quarter. They see a lot more risk than what stocks have priced in so far. So that's the S&P 500 daily chart, down 2.1%. That's the 50-day moving average there that it nearly touched on Friday. And here's the Dow down 2.5% on the week, blew right through that 50-day moving average. Here is the NASDAQ 100. So this is a daily chart. That's its 50-day. It lost 1.65% on the week. I entered a short position over here on Thursday. We'll maybe talk about that a little bit more in a minute. And let's take a look at IWM small caps that have really been leading all of this since January 17th. Here is IWM daily chart again. That's the 50-day moving average. You can see it consolidated around that a little bit this week and blew right through it on Friday. So down almost 3% on the week for IWM small caps. And they have been leading the market lower since right here this Friday, January 17th, with this dark cloud cover candle. I mean, look at this drop since then. Crude down more than 5%, copper down some 6%, and gold up about 1% on the week. And that's a theme we've been seeing a lot the last couple of weeks, is crude and copper getting killed and gold moving higher. So that is a risk-off growth concerns kind of environment. So let's pick up from where we left off last week. That was the S&P 500 breaking this December-January uptrend last week. And ending with this small, almost like a little bear flag on that preceding Friday. So this was Monday, just got walloped. I thought we would see some more downside in the beginning of the week and then kind of move to consolidation as the Federal Reserve was meeting midweek. So that's what I expected. That's pretty much what we saw. What gave it away for me was actually the dollar-yen pair. Let me pull that up real quick. And this is a 30-minute chart of USD JPY. So it ended similar to S&P last Friday with this kind of flag formation, but it actually broke down that Friday while the S&P still held above this, and this is what it looked like, coming into Sunday. So dropped some more before the major averages did. And what we noticed was Monday morning, while index futures were down, the dollar-yen pair had already started consolidating. So my feeling was that the market was going to sell off in the morning on the open, which it did, and then we were going to go into consolidation. I mentioned in last week's video that we were long volatility, and this is how last week ended, so we had a good start. On Monday morning before the market opened, I told my members that I was probably going to close out that long position in volatility shortly after the open because kind of expected that the market was going to consolidate. So here was the open, big move on Monday in volatility, and got out for a 40% gain on that trade. And that was a good call because this is what the S&P did on the open. So got out of that VIX position, shortly after the open, and it did consolidate the rest of the week over here, or most of the rest of the week. Now, by Monday morning, there was already evidence in multiple asset classes that we were going to see a consolidation for at least a couple days. I thought into the Federal Reserve on Wednesday over here, and that's pretty much what we got. And I'll show you in a minute, but we got this consolidation through Monday. Tuesday looked like a pretty strong day, a big, strong open. What we did see of interest was after the Fed over here on Wednesday. And the fact that the Federal Reserve meeting was Wednesday was one of the reasons I also thought the market would consolidate into that meeting. So here's the SPY with 3C in orange, and this is that consolidation. This is Wednesday, and this is the little teeny knee-jerk reaction to the Fed and to Powell. So right after that, into the afternoon, into the close on Wednesday, saw 3C slipping down pretty bad. Again, on Thursday, the market just strengthened out of nowhere after the WHO declared this virus international pandemic or emergency, whatever they said. But notice, 3C did not confirm that. So again, you get an hour of decent price action, and the people on CNBC are going nuts that this market is a buy and, everything's overblown. And what we saw here on Friday was exactly like the previous Friday. There were no buyers. There's a little minor attempt to find support down here, and then that fell off real quick into the close, and 3C started leading lower even before prices. So that's what 3C looked like as we went through that consolidation. There were other tells as well, and this is a good one. It's been working really well in 2020. So this is the SP 500 in the red and green candlesticks and IWM in white. And this is why I said on the 17th, IWM was showing trouble as early as the 17th, and it's just led the market lower since then. So here's that FOMC right here. Notice what IWM small caps are doing, leading lower as stocks were trying to move higher. So it was another good signal, and while the people on CNBC get all excited because there was an hour of decent trade, there were much bigger signals that were just saying, if you're short, stay short. One of the most notable was price action itself. So here's that previous Friday, little flag, and here's Monday. What do you see? It's a bear flag. It's not perfect in the S&P 500, but in a lot of other places and a lot of different assets, not just stocks, we're doing the same thing. I just showed you the dollar yen was doing that and actually forecast or led the S&P 500 into this. Here's the Dow. I think you can see the flag a lot clearer here. So that strong last hour of trade on Thursday, in Thursday's daily wrap, I said, yeah, it was a strong hour of trade right here, but it did not change the outlook at all. We still have this bearish flag that had already broken. So this was just a back test. And you can see the same thing here in IWM. There's the flagpole. Here's the flag. This was the break of the flag on Wednesday. Okay, so even before Thursday, and another little bearish consolidation. That's that strong hour on Thursday. Did it change anything? Did it make a higher high? No. So it remained a bearish environment. So let me follow through from last week's video and touch on a few S&P sectors because this is interesting and it'll probably have an influence into next week. Let's start with industrials, XLI. Okay, so last weekend in the video, I said XLI at that point had been holding this $82 level, and this was a key area to watch, and it held it really all week until Friday, so it broke down. But there were warning signs. The growth-sensitive sectors and the cyclicals have been performing really weak this past week, and let me show you how they've been leading here. So what I've done is added the Dow transports in blue here and normalized it to the industrial sector. So what you might notice was an equal low over here for XLI. So it held support there. But if you look at the transports, they made a lower low on Wednesday, Thursday. So this was telling me this last hour of trade really meant nothing, that we had a really growth sensitive sector leading XLI lower, and XLI broke below that 82 on Friday. While I'm on transports, might as well touch on them. So this is a 30-minute chart here of the Dow transports. So you see the same bear flag in Dow transports this week and the same break of the bear flag. So last weekend I was saying this 10,950, just under 11,000 level is really key. So it just probed above that, but still did not change anything. It just kind of filled this gap over here. It didn't change the technical outlook. This is still a bearish flag. And here we have that second leg down. This is still about 2% above my downside target. So I think it still has more to go in the immediate term. Here's the financial sector, XLF. So we got about a 5-week consolidation. Regional banks and banks in general were leading the sector lower below this consolidation. So notice what happened on the week here. We do have a consolidation. It's not quite like a typical bear flag, but for practical purposes, it is not getting above this resistance, former support. So this sector has not made a second leg down. So I lean towards this coming down more. The yield curve has led also down here. So the bond market has been sending signals about growth, and that weighs on the banks because of net interest margins. So this is XLF still, and I just added the regional banks. You can see over here is where they had a change of character. We talked about these changes in character of their price consolidations. And over here, it starts leading lower, as you can see. So again, we have that same situation as we saw in industrials with the transports, holding support, not making a lower low, but relatively speaking, we see the banks making lower lows. So they are leading lower, which leads me to believe that the financial sector will break and make a second leg lower here. Here's another one from last week, XLY. This is the consumer discretionary sector. So this is kind of the risk-on sector. Consumer staples is the more defensive sector. So like technology, this is a FANG-heavy sector. Amazon is the biggest component in this sector. So it did break that trend last week. This was last Friday where we left off the video. So there's Monday. And this is another bearish flag. Amazon had monster earnings Thursday after the bell, and that supported this sector. on Friday. So it's still technically in this bearish consolidation. It did not change the trend. It did not make a higher high. It did not get above this trend line. So it's still technically bearish. I've overlaid the retail sector in blue over consumer discretionary. And again, same message. People don't really care about these messages when prices are above trend and they're like, oh, I don't care. But it was leading lower, and we can see the same thing this week where this is consolidating in kind of a bearish flag. It's not textbook, but still bearish flag. And what is this sector doing? It is making lower lows and lower highs. It's already made first leg down, consolidation, second leg down. I think the path of least resistance is down. And here's the most heavily weighted, most influential sector, technology, XLK. Touched on this in the video last week. We had two trends. Basically, this is the December-January uptrend, and this is the accelerated January uptrend. So we had broken that trend as of last week in that video last week. And what I said was I thought it was going to hang around this lower trend line until Apple's earnings. So it did break below it a little bit on Monday, but then Tuesday got right back above for Apple's earnings. It's probably a little fuzzy, but you can see here we have a bearish flag. And again, the sensitive, growth-sensitive subsectors are leading lower. So here's XLK with the Philly Semiconductor Index in blue. The same theme. XLK does not make a lower low as it's trading in this bearish flag. We can see that the semis do. Okay, so they are leading lower. This was their consolidation here. They already broke below it well before XLK did and continued to make lower highs and lower lows. The path of least resistance is down. So I don't remember whether or not I had covered this stock in last weekend's video, but I've been covering it for my members because it's interesting and it gives some perspective. This is International Paper. They make shipping boxes, cardboard, they make paper products. So if you expect that the economy is going to pick up and growth is going to pick up due to this trade deal, which we've been discounting since October over here, then this would be one of the stocks that should benefit from that pickup because they're going to sell more cardboard shipping boxes, right? What was interesting to me, and the reason that I've been covering this for my subscribers, was that before we even got into this whole pandemic, they were already looking ugly in the very end of December and into early January. And they went into a perfect bearish flag over here and broke down, another little flag and another breakdown. My point is that this sector was looking ugly, or this stock, was looking ugly well before this coronavirus became the market's focus. If you remember this basic Q3, Q4 2019 trend of a bounce, you're going to see a lot of assets in this video that look very similar. And that is to say, a bounce on trade optimism and then rolling over into 2020. Here's Dow Inc., same thing, world's biggest plastic maker, coming into 2020 over here, bearish kind of decline, but holds support, does a little bear flag right above that support, and then breaks support. So this is one of those companies that should benefit big time and should be leading the market higher if growth and inflation are going to reaccelerate higher. Here's USO, crude oil, picking up where we left off last week. We had this kind of broadening formation I was talking about. Look where it is. It's almost at the bottom of this broadening formation trend. This is almost a 20% decline in crude oil. This line over here was my measured move downside target, so it hit that. I think this was Thursday and just blew right through it on Friday. Just because we hit a target doesn't mean it can't go lower. That's just a reasonable place to expect, not necessarily a bounce or a reversal, but at least a consolidation. Crude oil is just sending a very ugly signal about what it expects about growth moving forward. This is a 20% decline. The last time we saw something like this was in 2018, about October. Instead of using copper futures, I'm just going to use CPER, the ETF. Here's that same trend I was talking about from Q3, Q4 of 2019. Okay, this is that trade optimism trend. Copper has been down, I think, 11 or 12 consecutive days. That's a record. It's never been down that much. Look at this drop. What kind of signal is copper sending? Last time I saw something like this coming from copper, we got a 20% sell-off in the stock market. So that was right back here. Notice when? June, July into August. And when did the stock market sell off? The stock market didn't sell off until October. And this is what happened. 20% decline in the S&P 500. So copper was sending that signal back here in June, July. And what copper was saying back here was that growth and inflation were turning down. Stocks got the message later. And instead of kind of just coming down and pricing it in real time, like commodities, like the bond market, like currencies, they do it all at once. So these are some big opportunities, but this can go on for quite a while, like we've seen the last several months. And the fact that the Federal Reserve has pumped $400 billion into the market over the same period. But I just want to really show you that the commodity market, the bond market, and currency markets are taking this much, much more seriously than stocks are at this point. So a 2% decline for the S&P is nothing compared to what these different assets that are growth sensitive are reflecting. Touching on gold real quick, I think last week I touched on it in the video, and we had this kind of consolidation. So big 5-month consolidation here, breakout or first leg, and consolidation here. And then what I pointed out was we had a bullish triangle right here, and gold was getting ready to move on the upside. So we'll take a closer look at that. This is the start of the consolidation. It started to look like a flag. This is a 15-minute chart, by the way. And here is the bullish ascending triangle consolidation. This is when I brought it up to my members. I said, look, it looks like a really great risk-reward opportunity because you have resistance here at 147, so you get a breakout above 147, and you had support at that time here at 146. $1 of risk for, a big upside move as far as my upside target goes. While stocks were down on the week, they spent most of the week in consolidation. What did gold do? Similar. It was up almost 1% on the week, but consolidated in another bullish ascending triangle. So you have that lower trend line here about 148.50 and the upper just below 149.50. I'll update the targets on the site for members. But really, the reason I brought up gold is because of the way copper is trading. Copper looks horrible. So copper is a risk asset. It goes up when things are good, when the economy looks good. Gold is a safe haven asset. So let me show you the gold-copper ratio because it tends to lead bond yields. This is a 30-minute chart. The red line is the copper to gold ratio. The blue line is the 30-year yield. Let me take off the 30-year yield. Does the trend here from September, October look familiar? This is the 30-year yield. Here is the peak of growth and inflation in like Q3, Q4 of 2018. Here is that same trend, that bounce from basically October, the trade deal trend, and that break. So bonds and commodities are on the same page. Stocks are not. There's one other asset class on the same page, and that's currencies. Had the same kind of decline in the Australian dollar versus the US dollar. Australian dollar is a commodity currency. So here we get that same bounce, right? September, October, November, December, same trend break over here in the last couple of weeks. Here's the CRB index, same trend over here, same break of it. The takeaway is the bond market, commodity market, currency market are all on the same page, and that actually reflects some of the economic data. Now, I say some of the economic data, not all of it. This is manufacturing PMI. We know that manufacturing went in the toilet 2018 into all through 2019. So this is manufacturing PMI. Here's that global growth slowdown into 2016 and the reacceleration of growth, the globally synchronized growth trend. Here's the rollover in 2018. Okay, same thing that bond yields were showing. This is the bounce we've seen over the last quarter, and this is the data turning back down. So you might notice the same kind of trend. The data over here for PMI manufacturing is reflecting the same thing that commodities are, that bond yields are, that currencies are, but not all of the data looked this good. And that brings me to the Chicago PMI, which we just saw last week. So a couple takeaways. One, it disappointed. It missed. The other takeaway is look at the trend. It didn't see much of a bounce, did it? That is just a counter trend bounce in a downtrend. And the other takeaway is the reading. Under 50 denotes contraction. So out of 8 months, we had 7 months that are recessionary. Most of the macro analysts usually pay more attention to ISM manufacturing. Here it is over here. Look at the trend. No bounce, right? So this is kind of what I've been pointing out to subscribers is that while the market has gone on this rampage to the upside the last 3-4 months, basically pricing in an expectation that growth was going to turn around and reaccelerate, there's no evidence for it anywhere here. The trend is down, and again, over here under 50 is contraction. So you have 1, 2, 3, 4, 5 months of recessionary prints in manufacturing. And as we're starting to see last week with the Chicago PMI, that bounce in the data is starting to turn as well in the places where it did bounce. So that's why I point out the same thing happening here in commodity currencies, pointing to the same expectations, the same trend. The bond market, 30-year yield, same thing, same trend. The way commodities are trading, in this case, gold against copper, same trend. And here I've overlaid the S&P 500 just to make the point. The only asset class that hasn't gotten the message is stocks. But what I said early on in the video was a 2% decline in the S&P 500 is nothing compared to what all these other asset classes are reflecting. Okay, so before I wrap up this video, I want to show you one other development last week. This is the yield curve. This is the 10-month minus the 10-year minus the 3-month. The yield curve re-inverted last week. So let's get into next week. Has there ever been a case where the second largest economy in the world has essentially just been shut off from the rest of the world? Markets don't know where this is going, but you can see a lot of them are pricing it very seriously. Not so much stocks yet. The commodities are, the currencies are, the bond market is. The asset classes I expect will outperform will be defensive. So treasuries, gold, utilities, REITs. Utilities was the only S&P sector to close green last week. So next week we'll still have earnings. One of the focal points is probably going to be China coming back from the Lunar New Year. Market's been closed for a week. We may see some aggressive repricing or pricing on Monday. We also have the Iowa caucus, so Bernie Sanders looks like he might pull out a win there, and I think the market's going to be terrified of a Bernie Sanders presidency, so we'll see if there's any reaction to that. For members, subscribers, I updated all of my downside targets for the major averages on Thursday, actually on Friday before the close, and they were exactly the same as they were Monday when I first put them out. On average, the major averages have about 1 to 1.5% of downside to go before they hit my first measured move. Again, that does not mean that's as far as they can go down. It just means that's where I would expect some kind of support or consolidation. In the Nasdaq's case, though, I have a pretty significantly lower target for the Nasdaq. So it has just barely started to break this bear flag. This was leg 1. We're starting leg 2 now. So that's why I opened a short over here on Thursday in Nasdaq specifically. A few sectors have already hit the downside target. For example, materials. Leg 1, consolidation. Leg 2, XLE. It blew through the downside target, which was actually, I think, right about here. So it's already done that. The second most heavily weighted or influential sector is healthcare. So it too hit the downside target. Then we have a few like XLF, financials, third most heavily weighted sector. So it is influential, has not started that second leg lower yet. And the most heavily weighted technology sector. There's the flag. It just started that second leg lower on Friday. Like the prior Friday, closed off the lows, but this is not a great close at all. The only thing that the S&P has going for it is this 50-day moving average right here, technical support. Then you have others like the Dow or small caps that just blew right through that. So 6 of one, half a dozen of another. I think we'll probably see a little bit of selling on Monday like we saw coming into this week. It's almost an identical kind of close as this prior Friday. All right, so that will do it. If you enjoyed the video, please give it a thumbs up. Feel free to leave comments or questions in the comment section. Don't forget to subscribe. There's a little link, I think, down here at the bottom right-hand corner at the end of the video. You can subscribe and get notifications of new videos. Also, check out the website. I have posted, and I will post more public commentary, some of the posts that go out to members, and I'll put those up on the website so you can check those out. Thanks for hanging with me. Everybody have a fantastic weekend.